Hello and welcome. In this video, we'll be looking at the role of a financial analyst. Okay, we'll be looking at that role from the technical knowledge point of view. Okay, so if you are interested in becoming a financial analyst, if you are interested in that career path, this video is for you. Stick around. So when you search for the job role of a financial analyst on recruitment websites like Accountancy Age or Monster or Reed, what you will find in the job profile, in the duties they need to carry out on daily basis, the financial analysts are expected to have in-depth knowledge of financial statements, and also, as the name suggests, they should be able to analyze the financial data. Okay, they should be able to analyze and examine the financial data and provide report on their findings to the decision makers. Decision makers could be the management of a business they are working for, or the decision makers could be their clients. Okay, so the most important aspect, or the fundamental aspect, you can say, of a financial analyst's role is to be able to analyze the financial data. Okay, now I'm assuming that you have basic working knowledge of financial statements, because that's quite important for this video. So that's what we'll be looking at today: the technical knowledge, the technical skills a financial analyst should possess, and we'll be doing it through a case study. Okay, I've developed a case study which will be quite useful for this session. So in order to conduct a good financial analysis, we need to have tools available. Okay, right sort of tools. Now, you may have heard before, read somewhere, or in a course you have come across that one of the important tools that a financial analyst could possess is the knowledge of ratios, financial ratios. Okay, ratios are important. Ratios are useful because when we try and compare the raw financial data, it's like comparing apples with pears. Yeah, so what am I talking about here? I'm talking about comparing results of companies on year to year basis, so looking at last 10 years results and see how well the company has performed. If you try and do without ratios, right, the comparison will be not quite useful, because the underlying conditions on yearly basis, based on which the company has arrived at those results, will be different. Okay, they may have different assets in during different years, they may have different liabilities, different resources. So we can't really compare the raw financial data and come up with some useful recommendations. We need to have some sort of common measure that we can apply to analyze that, and ratios are great for that. So we'll be using ratios in this session. So that's tool number one. And second is we need some sort of technological support. Yeah, if you try and do everything manually, say you are analyzing last 10 years data with pen and paper, it's going to be clunky, it's going to be tedious, right? So we want to avoid it. So we can use things like Excel to help us out with that. So we'll be using, there are other platforms as well which you can use, but Excel, because it is widely available, we'll be using that, and there are good chances that you have that on your computer as well, so we can use that. So we'll be using ratios and we'll be using Excel. Okay, now we can actually fetch data from London Stock Exchange of any company and use it in a case study, or we can have a dummy case study just to help us with this session. So what I've done is take an option of creating a dummy case study, okay, where we are looking at a company and we'll use the data from that company and analyze it. Then we can extrapolate it, right? You can extrapolate it. Instead of using that dummy company, whatever we create, you can embed data from results of a real company from a stock exchange and then see whether you can come up with the same results or not. Okay, so that's what we'll be doing. I'm using a case study of a company called Analyst Limited. All right, so let me just give you a background of Analyst Limited, what's happening over here. And that's given at the right at the top in this box, but don't worry about reading it. I'm telling you what it is happening. We are working as financial analyst for a company called Beta. Now Beta is Beta PLC in particular. Beta PLC is interested in acquiring Analyst Limited. Analyst Limited is currently listed on alternative stock exchange, alternative investment market. Okay, because it's a smaller, medium-sized company. It's a medium-sized company. So we want to make an investment in that, but before buying it, we want to check it thoroughly, right? We want to make sure that the investment is not going to be loss-making in future. So before acquiring Analyst Limited, we want to make sure that financially stable. Okay, there will be enough profit in future, the liquidity is fine, so on and so forth. All right, and that's a sensible thing to do when you want to make such decision of acquisition. You may be thinking about applying the same kind of tools to make your own investment. Say if you're interested in making investment in shares of public limited company and want to see whether the company is stable or not. Again, the ratios excuse me, could be quite useful there, so you can use those in that circumstances. So in this case, we are imagining we are interested in buying Analyst, and will be analyzing the financial performance and position of Analyst. We are particularly concerned about one thing in Analyst, and that's over trading. We are assuming there is a possibility that Analyst Limited is trying to expand beyond its capabilities. It's trying to sell lots and lots of goods, or generate lots and lots of sales by selling on credit. Nothing wrong with selling on credit, and that's usual common norm within the industry, within different industries, but it is dangerous when you are trying to give too much credit. In that circumstances, you are running a risk of bad debt, if you have heard of it, bad debt or doubtful debts. Now bad debt is where, or irrecoverable debt, where you are selling goods to customers who have a poor credit rating and therefore they won't be able to pay back. Okay, so selling too much on credit also runs a risk of that kind of possibilities. So that's what we want to check. Now we have been given financial statements of Analyst for last 2 years. I know it's not enough. We need to have 5, 6, 7 years worth of financial statements to have a meaningful analysis. But just to understand the principles, 2 years will do. Okay, so the first thing we have been given is statement of financial position, or as we call it, it's a balance sheet. And what you will see in that, in the balance sheet, is we have 2 years worth of data, 2017, 2018. First we have assets, and in assets we have non-current assets and current assets. So non-current assets, they are increasing, you can see between 2 years, and current assets are also increasing except for cash. So the cash has declined from 50 to 0. So that's one of the signs of a problem. Okay, they don't have enough cash to pay the bills. So there may be liquidity issues. When we transfer, when we divert our attention to the equity and liability side, what we can see, so let's first equity, what we can see is that they didn't issue any shares during the year, but the retained earnings went up, so that they made some profit. Let me warn you that profit is not same as cash, right? Company may be making profit, but that all the profit could be credit, and they may not have enough cash at the same time. Revaluation has gone up. That means they have revalued some of the assets. So if we go back to the current non-current assets and see the property, plant and equipment, you can see the value has gone up. Out of the total value, it has gone up by 100 is because of revaluation. okay, and the rest is perhaps their purchased assets on credit or perhaps on cash, we don't know. Then we have non-current liabilities, and in non-current liabilities the loans have gone up quite significantly. Okay, so it was 50 last year, 550 this year, too much. Then we have tax provision, that is going up, and then we have current liabilities, and you can see everything is going up, right? Payables are going up, tax is going up, and also bank overdraft has gone up as well. So interesting, very interesting. And as I say, it won't be right to start making comparison just now, because we don't know, right? We need to use ratios, we need to use a common measure for comparison purposes, which we'll be using later on. Now if you look at statement of profit or loss, which is also income statement, you can see sales and cost of sales are going up, but gross profit has declined. So they're making less, they're making more sales, but their profit has declined. Interesting. Then different type of overheads have been given. So we can say distribution costs have gone up, but admin expenses have slightly gone down. So they're showing some sort of control over these overheads of administrative costs. Finance costs have gone up, of course, because they have borrowed more. Tax has gone up, and at the end, in the other comprehensive income, which is kind of a memorandum attached to statement of profit or loss, we can see the revaluation surplus has gone up. Cool. So that's all the information we have, sufficient. What we want to do now is turn this information into ratios, okay, so we can start making comparison. So let's treat this first spreadsheet, yeah, as input, all right, and we'll create another spreadsheet which will be the output, and we'll label input spreadsheet financials, output spreadsheet ratios. So this spreadsheet ratios will contain some information that is coming from the input area, and then ratios. Okay, now we want to do a 360-degree analysis of Andress's financial performance and position. What do I mean by 360 degree? We want to look at Andress from all possible angles. So we just don't want to concentrate on profit, we just don't want to concentrate on liquidity, we want to look at everything. Okay, now in order to conduct a good basic analysis, you need to look at a company from 4 different angles. Number 1 is the profitability, okay, to check whether the company is profitable or not, or making enough profit. Second is liquidity, okay, liquidity, do they have enough cash? Third one is their efficiency or working capital. So we want to look at that to see whether they have good control over their day-to-day operations. That's the working capital. And number 4 is gearing. We want to check whether how much debt, how much riskiness there is in that business. So when we look at it from 4 different angles, that will be sufficient to tell us, give us some basic indications as to whether this company is worth investing or not. Now for profitability, I'm using 4 ratios. There could be many more ratios, okay, apart from this, but I'm using these 4 fundamental ratios, which include gross profit margin, operating profit margin, return on capital employed, and asset turnover. We'll be discussing those ratios as we go through. Then for liquidity, I'm just going to add extra column here, actually, sorry, row, 2 rows. So in liquidity, we will be calculating 2 important ratios, current ratio and asset test ratio, which tells us company's cash position. And then for working capital ratios, we are considering inventory days, trade receivable days, and trade payable days, which then should give us something called working capital cycle, which we'll discuss later on as we go through. Okay, And lastly, gearing. In gearing, to check riskiness, we check companies' level of debt in the total funds, and the second is whether they have capability of paying interest on time, that is interest cover. Brilliant. So those are the ratios we'll be using. Before start discussing the ratios, we want to calculate them, okay? And once calculated, we will then be able to analyze them. So let's start working. So apart from that first column, you can also see two more sections. The first section is called financials, which we are actually fetching, is a section to record data from our input spreadsheet. And then the second section is ratios themselves, where we are actually going to calculate the ratios. So the first thing to do is to get the data. All right, so bring your cursor to cell B8, put an equal to sign there, and then go to financials. We are working out the gross profit margin first of all, and find your gross profit. Okay, so that's that. Done. Right, so gross profit margin is gross profit divided by sales. So we have gross profit for 2018. Now we need sales for 2018. Same process, equal to sign, go to the financials, and then get the sales, equal to. All right, and we are going to be doing the same thing. So operating profit margin has operating profit at the numerator, that, and denominator would be sales, so sales. Okay, then return on capital employed is operating profit divided by shareholders funds plus long-term debt. So equal to sign, first the operating profit, that, and then underneath the denominator is shareholders funds plus long-term debt. So equal to sign, then open brackets, go to financials, we then go to statement of financial position, take the total equity figure, which is total shareholders funds plus long-term debt, which is long-term loans. Leave the provision for deferred tax out. That's not a it's not a long-term loan. Okay, it's not the borrowings. Brackets closed, enter. Okay, so we have that. Then asset turnover, for which we need cells. So go back, get the cells, and denominator is the same as above. So I can use rather than doing the calculation again, I can just put equal to sign and get the same figure which I recorded on the top. B15, that would be it. Okay, then current ratio, we need current assets. So go to financials and go to current assets section, get the total current assets, and that is divided by current liabilities. So denominator will be current liabilities. Again, we have total for total current liabilities, take that. Acid test ratio is current assets minus inventory. So equal to sign, open brackets. First we are talking about numerator, denominator is current liability, that doesn't change. So current assets minus inventory. Okay, so that's that. And current liabilities, we have recorded it just now, current liabilities. Okay, then working capital will be inventory divided by cost of sales. So equal to sign, go to financials, and then find the inventory for 2018, which is in current assets. 260 divided by cost of sales, and that's in statement of profit or loss. So that's the cost of sales there. But if we just take the same figure, it will be minus. So we want to turn it into plus figure. So we'll put a negative sign first and then select the cell. So it turns plus. Click OK. Oops, wrong cell. Sorry, let me fix it. That's it. Let's do it here. So cost of sales, go to that, minus sign, and cost of sales. What's going on? Okay, doesn't like it. Okay, that's fine. Equal to sign, then minus. Sorry. Right, equal to sign, then minus, and then select the cell. Let's try that if that works. Yep, it works. Okay. Trade receivables, which is receivables. Yep. And current assets. And that's divided by sales. Okay. And then trade payables divided by cost of sales. So we go to financials, current liabilities, trade payables divided by cost of sales. We can use again to avoid the problems. We'll use the cost of sales figure we just used. So B32. Okay. We'll leave the working capital cycle out for a minute. We'll calculate it later on. Gearing is long-term debt divided by shareholders funds. So long-term debt, first of all, long-term debt is long-term debt, that, and that's divided by shareholders funds or total equity. So total equity in the under the equity section, the total. And interest cover is operating profit, first of all. So go to your statement of profit or loss, find the operating profit, and that is going to be divided by the interest. So put a negative sign first, then go to financials, and then select the interest or the finance cost. Okay, enter. Oops, wrong cell over here. Right, so we have got all the data for 2018. What we can do now is copy it across, so we get 2017 figures as well. So select the entire section of column B where we have the figures, bring the cursor to bottom right hand corner, let the plus sign turn dark plus, left click and hold and drag it to right. Okay, one more time. So select the B column, bring the cursor to bottom right hand corner, left click, hold, drag it to right, and we can see they have copied pasted, Excel has copied pasted the figures for 2017. Just to check, gross profit is for 2017 is 342. Go to statement of profit loss, gross profit 2017 342. Brilliant. So that's done. We can now work out the ratios, calculate the ratios. So now we'll do the ratios, work out the ratios. So 2018 gross profit margin is that gross profit divided by sales. Okay, good. So right now the answer is in decimal places. We'll turn it into percentage, and just to turn it into percentage, click back on that cell, go to your numbers section in the home tab right at the top. There is a percentage sign right there, so select that. It turns it into percentage. If you want more decimals, in the same section you have increase or decrease decimal option. We can increase it to 2 decimal points to see whether it's right or not. Okay, it's accurate or not. Okay, we'll continue to do the same thing. Operating profit divided by divided by sales. Okay, all right, again percentage, increase decimal, return on capital employed, keep doing it. That, okay, that's in percentage, increase decimal. Asset turnover is not in percentage, so it's in times, so we'll do that divided by that, and that's it. Okay, let the result be in times. Let's just write times over here. Okay, so these are 2018 results. We can do the same thing of copying pasting across. So select column E, bring the cursor to bottom right hand corner, let the plus sign turn dark plus, bring it to right, on to the right side. Okay, so very interesting. That number looks very big. Let's make it smaller, decrease decimal. Yeah, so what we can see from the profitability point of view, right, is clearly their gross profit margin has declined. Their sales have gone up, but it means that cost of sales have gone up by even higher proportion. So their sales increased, but their cost of sales has increased at a greater rate. That has resulted in a lower gross profit margin. There could be a variety of reasons for that. Okay, increase in cost of sales. The company may be buying too much on credit. The suppliers may see that as a risk if the company is usually buying more than that they do in regular business. Usually it doesn't pose a problem, but if the company is trying to expand very fast, everybody can see there could be trouble within the company, and as a result the suppliers may increase the price. As a result, the cost of sales may be going up. Okay, or it could be if it is a production business, then perhaps it could suggest higher production costs, maybe because of wastage or higher labor costs. Could be anything really. Okay, so one thing, the primary profit has actually declined. Now that has resulted in further reduction in operating profit margin. Operating profit margin has gone down by 4.67 percentage points. Gross profit margin has declined by 6.5 percentage points, but this has gone down by 4.67 percentage points. Okay, now the primary reason is decrease in gross profit margin. That has resulted in further operating profit margin going down. But in addition to that, you can see the distribution costs have also increased, which means that the company is trying to expand, trying to generate more sales. We can see how the sales have increased, and as a result perhaps the distribution costs are also increasing. Okay, so the cost they need to incur to get the product to the customer. We don't know whether it is part of their strategy. Perhaps they are offering free deliveries to the customers, to their clients. All right, and that as a result they are bearing further distribution costs. But the administrative costs, we are saying that it actually has declined. So they have better control over administrative costs now. So that's a plus sign. Again, variety of reasons. Maybe they have reduced number of staff. Okay, that actually reduces administrative costs, but there perhaps quality of work will be suffered because you have now fewer members of staff working. Again, more information we need to analyze further. Now all that has affected the return on capital employed, which is the return the business generates on the cash or the investment their investors have made. And by investors we mean the shareholders as well as the loan providers. So they have invested money. Last year 2017 was 950. This year is 1.6 million. The main reasons for increase in the denominator is, number one, the long-term loans have increased. They are borrowing more funds to fund their business. Okay, but from the equity point of view, there is no increase apart from the profit they made last year in 2018 of 50 and revaluation surplus. Now let me warn you at this point that this profit of 50, right, may not be a good profit, because as we can see, the company is trying to desperately to expand their sales, and this extra 50 of profit may be credit profit, so may not be a good profit or cash profit. So it's, and plus the revaluation surplus over here, they are revaluing the properties on paper. That doesn't necessarily bring in extra cash. So really the extra funds that has been injected into the business for further expansion is really coming from long-term loans. They're borrowing more and more funds to fund the expansion, to fund the business. So that is affecting their ability to generate return on the money invested, right? Because we know their operating profit, their efficiency in generating profit has declined from 200 to 180. Operating profit, that has gone down, and they have invested more funds. So they're investing more funds, but they're not showing the signs, they're not showing the ability to generate more profit. Okay, that could be a sign of trouble. But let's be critical over here. We know that normally when the business makes investment in long-term assets by borrowing funds and all that, it won't generate profit straight away. It will take time. So it could be that. So we don't need to be very harsh on NRES over here for not being able to generate profit straight away. Maybe the company is taking time in terms of generating profit because they have just borrowed extra funds, invested in business. So that's that. And asset turnover. Asset turnover shows how efficiently they are generating sales for the money that they have invested in long-term assets, or how efficiently their assets are working to generate sales. Now, as we can see from here, their ability to generate sales has also declined. All right, last year it was 1.2 times, and this year is 0.9, so it has gone down. So when we put this operating profit margin and asset turnover together, right, when you combine those two, we get return on capital employed. All right, let's put that theory to a test over here. So I'm going to just work out an additional working over here. All I want to do is multiply that operating profit margin with the asset turnover, and hopefully we'll get the return on capital employed. Yeah, there you go, 0.11.25 or 11% or 11.25%. If I drag it to right, yeah, it's exactly right. So really the company's ability to generate return on money invested depends on two things. Number one, whether they're generating enough profit, and number two, how efficiently they're using the asset. Now, in both departments, the company in question has not performed well. All right, and that could be because they have just got the funds from outside, and those funds have just been invested into the assets, and it may take time in generating profit, sales, and therefore profit, or it could be other problems as well. Yeah, we know that the cost of sales has gone up at a great rate than sales, and therefore it has resulted in lower gross profit margin. So they managed to generate good sales compared to last year, but they did not generate enough profit. So the profitability is area of concern. Okay, so this may suggest over trading, but let's be sure about it. So next item we are going to be looking at is the liquidity, company's ability to generate cash and pay bills. So the first of all, we want to work out current ratio, and current ratio is current assets divided by current liabilities. All right, so that's that. Bring it to right. Quite big figure, so we are going to make it small. Let's call it times. Okay, let's calculate the quick ratio as well, which is that divided by that. Okay, bring it to right, make it smaller. Okay, and call it times. So what we can see from liquidity is that companies' ability to generate cash and pay bills has also declined. So last year their current assets were 1.42 compared to every £1 worth of current liability. This year it has gone down to 1.1. Quick ratio or acid test ratio last year was 0.7, this year is 0.4. Quite significant decrease. So the current asset shows companies' ability to pay short-term bills. If they dispose of all the current assets right now, if they sell everything, so inventory, they get money back from the receivables and they use cash, will they be able to pay the bills? Yes, they will be. They still will be, but they won't have anything much left after paying the bills. That's what 2018 results are telling us. Now let's be a bit harsh as well and ignore inventory from the current assets, because inventory we know is not readily, sometimes not really readily sellable. Okay, it can go obsolete. Anything could happen with inventory. There could be a fire in the warehouse and inventory can be burned down to dust. So in that case, to avoid that possibility, we actually ignore the inventory from current assets and then compare the remaining current assets with current liabilities to see whether we are still able to pay the bills. When we do that, the results don't look very good. They don't have enough cash right now to pay the bills if they fall due. Okay, so last year was only 70 pence, this year is only 40 pence. So every £1 worth of liability, they have only 40 pence worth of highly liquid assets available. That is cash and that is receivables. And we know from the financial statements that the company did not have cash in 2018. So no cash. They are solely relying on trade receivables. To generate cash, they can pay back to the liabilities. But what did we say about their sales? They are in credit terms, and because they are aggressively expanding, not all of the receivables may pay on time. Okay, and therefore some of them may be bad debts, and therefore they may not have enough cash to pay the bills when they fall due, when the bills fall due. Okay, so that's liquidity. That doesn't show the good picture of the company. Working capital is company's ability to control their day-to-day activities. Do they have good control over their working capital, the money they invest in day-to-day business? For that, we check three things. We check how many days they're holding the stock, that's inventory turnover, how many days your receivables take to pay back, and how many days you take or we take as a business to pay back to our payables. So because those are days, what we do is we multiply the equation, which is for example for inventories, inventory divided by cost of sales, we multiply it with 365. So because there are 365 days in a year, by multiplying the equation by 365 we get answer in days. So let's do that. That divided by that into 365. Okay, bring it to right, make it smaller, round figures. Receivables, that divided by that into 365. Bring it to right, make it smaller. Payables, that divided by that into 365. Bring it to right, smaller. Okay, so these are all days, in days. All right, and last one, the working capital cycle is, let's write it at the bottom, is inventory days, ID, plus plus receivable days, RD, minus payable days, which is PD. Okay, so if we apply that equation, that plus that minus that, 52 days, 2017, last year 20. Right, so what is happening here? For working capital cycle, we have used inventory days plus receivable days minus payable days. So imagine a business cycle. We are holding the stock first for 81 days before we are selling, compared to last year. Last year was 51 days. So the goods are sitting in our business. Maybe it's a raw material, that's after conversion, and then in conversion, and then at the end finished goods. So that process is taking longer, or even after completion of the process, perhaps the goods are still sitting in the warehouse for 81 days. Then the goods are sold to the receivables, and they take 37 days to pay you back. Last year was 24, this year is 37. Again, increase. Is it company's deliberate strategy to give more higher credit period? Who knows? Or it could be, or maybe it's a deliberate strategy. But then the problem is that because they are not paying on time, the receivables are not paying on time, we can't really pay the payables on time. That is affecting our payable days. Last year we took 55 days to pay payables. This year we are taking 66 days. So altogether, last year we needed to fund the business in terms of working capital for 20 days, right? So when the goods are in the business, inventory days, for example, you have got the goods, then you have sold the goods to the customer. So 51 for plus 24 days, that works out to be 75 days. You will not receive cash for 75 days. The cash is stuck within this assets for 75 days, right? But your payables will ask for money back after 55 days. So you won't get money until end of 75th day, but your payables will be knocking on the door after 55 days, demanding their cash back. So the difference between that 20 day period after you pay your payables, right, until the money comes from the receivables is 20 days. And what are you going to do for 20 days if you don't have cash? You'll have to rely on short-term funds like bank overdrafts to fund the business for that gap. And that gap has increased from 20 days to 52 days. Yeah, and that actually is reflected in our current liabilities. We can see our bank overdraft has gone up. So we are relying on bank overdraft more and more. Yeah, so that's a problem, and that liquidity or working capital does tell us that. So working capital cycle has gone up. Higher the cycle, the riskier the business is, because you don't have enough cash on hand to pay the bills. You are actually relying on these short-term funds of financing. Why is it a problem? Those funds are not free. You will be paying interest on that. Okay, and we know that we are paying higher interest. All right then. So again, working capital, from the efficiency side, the business is not doing very well. Now let's check the riskiness of the business. Long-term funds. So the first thing we want to work out is gearing. Gearing is long-term debt divided by shareholders' funds. So that divided by that. You can turn it into a percentage, or you can keep it as times. We are going to turn it into percentage. So percentage, right? and then interest cover is that divided by that, and it's not percentage for sure, it's times. Okay, so make it, yeah, times. Slightly bigger this one. Right, so what can we see? First of all, the level of debt within the business has risen. Okay, it has increased last year compared to every pound worth of shareholders funds, which is company's own money, you can say. Compared to that, the level of debt was just 5%. All right, or 5, yeah, was just 5% of that total shareholders funds. This year it has increased to 52%. So it has gone up quite significantly. So it's quite interesting concept, because why are they not going to the shareholders first of all to get the funds, and why are they relying on long-term debts? Yes, the debt is cheaper than equity, which is to say that you pay lower rate interest compared to the dividend that you have to pay to the shareholders. But then it's kind of trade-off, isn't it? Because if you go to shareholders for money, it's not borrowing really. You are not obliged to pay dividend every year. Yeah, but if you borrow money, then you must pay interest. So it is interesting to see why they are borrowing rather than going to the shareholders, where they can tell the shareholders that, look, we are not in a good position, we need money, we won't be paying dividend now, but we'll be paying in future. Perhaps they are trouble, they cannot get cash from the shareholders. Maybe they know that the company is risky, therefore they're not interested in investing. And interest cover, which shows really company's ability to pay interest, okay, to cover interest. So are they generating enough operating profit through which they can pay interest? Last year it was 40 times, so your operating profit was 40 times higher than your interest. But this year it has gone down quite significantly. All right, it's just 10, right? It's 10 times. So your operating profit is not as great in terms of interest cover as last year, right? So, and if the company continues, it's not cause of concern at the moment by just looking at that figure, because it's quite high, significantly higher than interest. A company can survive with 2.5 times worth of interest cover, but the problem here is that the quality of operating profit, is it cash profit? Perhaps not. Its loss of profit is coming through credit. It's not turning into cash. If it was turning into cash, then we would have a higher asset test ratio, okay, on a higher current ratio, but they don't have enough cash. Whatever they're generating, it is possibly in credit terms. So an interesting thing to find out further, perhaps if we need more information from Analyst, we would say, can you tell us as to what proportion of total sales is cash sales and how much is credit sales? That will tell us. Okay, so yeah, so we looked at profitability, liquidity, working capital, and gearing. None of the areas are giving any kind of positive indications as to the business is in good condition. So our advice to Beta Limited, based on what we have seen, should be to be cautious, all right, in terms of investment, because they are generating profit, but the profit is declining. Number one, okay, the return on capital employed is not higher compared to last year or even equal to last year. One possibility could be because they have just invested money into the business and therefore they are not able to generate cash or sales now, but it will be in the future. That was one of our theories, but that is actually overshadowed by the other areas that we looked. They don't have enough cash, their liquidity is poor, their control over working capital is also poor, okay, and their gearing levels are very high, okay, and all of those suggest that perhaps it's a good idea to stay away from that company. Okay, so this I hope you enjoyed this, because this is the kind of activity a financial analyst would do. This is at very lower level, low skill, but then there will be other complications as well. All right, so not just the financial side is that what you need to look at. You probably be looking at other non-financial factors as well. So in this particular scenario of Andress Limited, perhaps it gives different kind of strategic advantage to Beta if they go ahead and buy this company. Perhaps the company is in such a location where it gives them a good competitive advantage. All right, so those factors will need to be considered as well in decision making. But the idea was, this is the kind of a primary knowledge a financial analyst should possess, and you should be able to deal with that. So if you enjoy this kind of analysis, if you are a fan of this kind of analysis and financial statements, this career prospect is for you. All right, great. So I hope you enjoyed this activity. Oh, before we go, you can do the same similar kind of analysis, but look at a real company this time. And for that, go to London Stock Exchange website. All right, just type in londonstockexchange.com, and then in the search bar type in any company. So I was searching for Tesco early on, so Tesco, and then it gives you different options. So we are looking for Tesco PLC, so click on that, and then when you are in Tesco's web page on London Stock Exchange, then head towards fundamentals. Click on fundamentals, and then you can copy and paste their income statement, yeah, and balance sheet, right, up to here. You can copy that, Control C, and then head to a new sheet of Excel, and then Control V there, and you will copy paste all the figures. Okay, once you have done that, so we have 5 years worth of results. The only issue over here is you can see the years are in ascending order. So the first column is 15, then goes up to 19. So be a bit careful. You may have to rearrange the columns, but it actually provides you all the, look, the first one is income statement and everything that we have seen. And then we have balance sheet or statement of financial position and the kind of similar items that we have seen. Yeah, all the way to capital and reserves. The layout is slightly different, okay, than ours, but yeah, you are familiar with that layout as well. So have a go, try and use the ratios for your preferred company. It could be Tesco, Sainsbury's, Tesla, anything really, and try and see how well the company is doing over 5 years. Be a financial analyst. All right, so that's your activity. Thank you very much.